I'm going to give you the impossible task of telling me the definitive driver of weak dollar right now, because every day I read new contributing factors. I mean, negative real yields. Is that at the heart of it? Is it this push higher we've seen in inflation, very small by global standards or by historic standards, but still relative to March, a slight push higher in inflation and the low yield environment? Is that at the heart of it? What's the real driver?
You know what, I think there's various factors all coming together. Negative interest rates are certainly part of it. I mean, it is unusual perhaps in the US to have negative interest rates, but we have had it before. But I think this time, because nominal interest rates are so low, there is this perception that yields or interest rates could be negative for perhaps a more protracted period. But I think the whole the whole inflation argument is a really, really interesting one. I mean, already today, of course, we saw that stronger than expected UK CPI index. The economists are not of the view, particularly that we are going to see a lot of inflation because, of course, we are expecting to see higher unemployment levels. We've got pressure on wages, etc. We don't think that producers are going to be in a position to push on higher prices. And also, of course, for decades now, we've seen real problems in the developed world to push wages higher. So that's the economist's point of view. But of course, many people are taking a different stance. Look at gold price, for instance. That is linked to negative interest rates, negative real interest rates in the US, and also expectations that we could see asset price inflation push higher in the way that we did after the QE was initially used in the US during the global financial crisis. So a really broad debate about inflation over the next few years, and that certainly is part of the factors impacting the dollar. But a Democratic president and potentially another pressure on the US growth outlook, it tends to bring more regulation and higher taxes. So a big variety of reasons. But I think right now we have a lot of momentum behind this dollar weakness. Come September, I think we could have a correction for some of the losses that we've seen.
It's interesting, isn't it? Because taking all you've said there, Jane, and then asking the question whether the dollar is still the haven, it certainly was during March. And every time you raise doubts about the dollar as a haven, it proves to be one. Once again. So I'm mindful of that. But I was reading Stephen Roach's piece some months ago talking about a 35% drop in the dollar versus a basket of countries that the US trades with. That was his expectations, 35% drop. And he was talking about how the poor savings in the US and the current account problems would eventually undermine the dollar. They'd push up the yuan, push up the euro, and the dollar would fall. Is that something that in the end undermines the dollar as a haven, or no, do we not get there?
You know what, I don't think that we do get there. At least if we did get to a scenario like that, it could be several decades out. And the reason for that is that the US dollar is still the dominant currency of the global payment system. And although there have been attempts by perhaps China to try and alter this, even the EU have tried to put some momentum in place to try and alter this, it's going to take a very, very long time to change this. People need dollars. They need dollars to finance their debt. The amount of dollar-denominated debt issued by foreigners has been really growing since the global financial crisis. And of course, dollars are the big currency for transactions. Now, that is really quite interesting. There's some research by the BIS, I think it was published in December, that suggests that the currency that invoices are issued in is a real significant factor between which currencies that the central banks have in their reserves. And that cannot change very, very quickly. So I think the dollar will remain a safe haven, irrespective of its current account and budget position, really for some time, for some decades. And again, this is a function of the intrinsic characteristics of the dollar, its use in transactions, its liquidity, more than the intrinsic qualities of the US economy.
Yeah, I remember being recently quite surprised at the number of Chinese businesses, or rather the scale of the use of the dollar in trade by Chinese businesses, regardless of the fact that the Chinese government, of course, wants to push the yuan as a trading currency. Let me ask you about what you foresee then for the dollar. So it would take decades for that kind of scenario to develop that I put to you there from Stephen Roach. But I've read interesting thought pieces also about how Americans do seem to be preparing for a weaker dollar, maybe just a slightly weaker one. But if you look at what Warren Buffett is doing with gold, or the rate at which Americans are now buying housing, some people were suggesting that this was all about preserving wealth. Do you see any of those signs, Jane?
Well, I think if you were worried about inflation, and of course many people are, then that would be the move to go. If you look in housing, that's a hedge against inflation. Gold is traditionally a hedge against inflation, and I think many people are concerned about the characteristics that we did see after the global financial crisis. We saw a lot of money being pushed into assets, intrinsic assets, not just housing, but also, of course, classic cars. We saw art, for instance. All of these assets really did push higher. And this, of course, related to very, very cheap money. And now the interest rates have turned negative, or real interest rates have turned negative. There is the possibility that we get another boost to these asset prices too. So again, given what we saw after the global financial crisis, this certainly is a risk.